let's talk a little bit about where we are currently, because we actually started this morning out pretty weak. This morning opened up, we were down about 14 points at the open, and we did manage to rally back throughout the day. And of course, not surprising, I talked about this last week, that we were likely going to get a rally because the markets had been so oversold here through last Wednesday. And I said, look for a rally Thursday and Friday. And this weekend's newsletter, I said, expect kind of a continuation of that rally into this week. This is a holiday trading week. It's a short week. Nobody's around. So pretty much the inmates are running the asylum, for lack of a better term. And we actually did get a nice recovery today. Now, a couple of important things that happened today. First of all, don't put a lot of weight into today's action. Again, it's a holiday shortened week. A lot of traders aren't around, so volatility is high and it's easy to move prices around. So robots were fast at work today, buying off this bottoming along this 100-day moving average that has continued to really be a good level of support for the markets here over the last couple of months. This 100-day moving average was support back in May. During that consolidation process, it's now begun to act as support again after this recent correction in the market. That's good news. As long as we can maintain that support level, that keeps markets in play. Now, one thing we'll talk about tomorrow, though, is the fact that this 200-day moving average continues to creep up towards where we are. And if the market breaks this 200-day moving average, we're going to get a bigger move to the downside. So it's something you definitely want to pay attention to. But over the next couple of days, particularly this week, there's a propensity for the markets to potentially trade higher here. First of all, we're moving in. We just finished a quarter. So we're now going to be seeing fund managers trying to reposition portfolios and trying to get things ready for the next quarter. So look for this market to potentially get a little bit of a pickup here over the next couple of days, particularly in this light trading week. But again, pay close attention here, because we are in a very big downtrend in the market from the recent highs. There's not a lot of strength in this rally that we saw today. And more importantly, breadth of the rally has continued to deteriorate. Today was mostly driven by the usual suspects: Facebook, Amazon, Google, Apple, Microsoft. Now, outside of that, if this market can make a move higher, we run into a lot of resistance very quickly back at the recent highs that we were just at the last couple of days ago. And that's going to be a big bunch of problem here for this market to move higher. So we really maintain this issue of being confined in a fairly tight trading range currently. And I know it's frustrating from an investment perspective. It's like, man, I just want to buy some stuff. I want the market to go up. I want to put money to work. We continue to hold excess levels of cash. We talked about this last week. We were trying to find an entry point to add some exposure to the markets. We haven't been able to find one yet. We're still looking for it. This is not going to be the week to add exposure to your portfolio, simply because there's just too much volatility. It's too short of a week right now, and there's nobody around. So really don't base a lot of faith in this current action in the markets, because this could really turn out to be a head fake very quickly, and you certainly don't want to get trapped that way. So we're just maintaining our cash right now, maintaining our fixed income exposure. We're still underweight equities and portfolios. We're probably going to stay that way for the rest of this week. Watch how this action kind of works out the rest of this week. There's still a lot of concern right now about what's happening with trade and with tariffs and what's happening overseas. In particular, Iran's been rattling up some rhetoric here over the last couple of days, in particular about restarting their nuclear plant. They're accusing the U.S. of chemical weapons on a ship right now. So that rhetoric certainly doesn't help on the geopolitical front. The tariff conversations certainly don't help. And this issue now with the election of the leftists in Mexico certainly doesn't help our relations with Mexico, or potentially any type of tariff resolution with Mexico, or the immigration problem from Mexico into the U.S. is going to continue to be a bigger issue. So all that's going to potentially weigh on the markets. As I talked about at the top of the last hour, the one thing that we're going to want to pay attention to, we're about to launch into the earnings reporting season for the next quarter. And when we start hearing from companies, we're going to want to watch specifically what they say about bottom line profitability, expectations for profitability through the end of the year, the impact of tariffs and higher energy costs on profitability, and also talk more, and we'll be watching specifically, what they're doing with their funds. Are they putting money to work, hiring employees, building up property, plant, and equipment, or are they using the majority of their revenue to buy back stock? Those type of things, right? So we want to see them investing into the economy, creating jobs, increasing wages. That's what we want to hear them talking about. We want to hear them saying, man, things are so good right now. We simply just can't find enough people to put to work, so we're raising wages. That's what you want to hear from them. If a large chunk of their conversation is about profitability, buying back shares, and looking for merger and acquisition opportunities, that's not the kind of economic language that you want to hear from these companies. You want to hear them excited and about the overall economy and trying to find places to put to work. Unfortunately, on a global economic basis, we're seeing slowing on a global basis. That will come back to the U.S. So I expect to see the rhetoric really much more subdued in the upcoming earnings reports. That will likely translate into, again, just kind of this continued sideways trading process as earnings are trying to catch up with prices. Valuations of the market still very extended here. So the longer the market trades sideways here, this does allow earnings to catch up with prices and helps reduce some of the overvaluation of the market.